Well, good morning. My name is Don Manzullo. I'm the president and CEO of the Korea Economic Institute of America. And today we're pleased to have with us four outstanding academics. We'll be discussing the unpredictable markets, impact on U.S. and Asia, and you can imagine that the comments will be all over the place, and that's exactly what we want. It's something very free-flowing, coming from the heart. Our scholars are Dr. Tom Cargo, Professor of Economics, University of Nevada at Reno. Dr. Jack Rhee, Senior Economist of the Asian Pacific Department, International Monetary Fund. Dr. Yoon Shik Park, Professor of International Finance at George Washington University. And Dr. Hugh Patrick, Professor of International Business at Columbia University. This forum is centered on world markets being increasingly erratic and unpredictable. Some people argue that the tapering of quantitative easing by the Fed may be a factor, and others disagree. And in the midst of all this, there's been an unexpected downturn in manufacturing indexes in both the United States and in China. We're going to ask each participant to give 5 to 10 minute opening presentation and then open the floor to discussions. Now, I don't know if unpredictability is synonymous with volatility, but there is a volatility index. And in fact, the Chicago Board Options Exchange actively trades that index. So people can buy or sell it depending on how much they feel the world markets are volatile. Of course, you can go to Las Vegas and legally bet on any sport, except no betting is allowed on the Olympics. And I would presume that because there'd be great interest in the spreads between the gold medal winner of the bobsled and the Jamaican bobsled team. So with that introduction, Dr. Rhee, thank you for coming.
Thank you very much. Okay. I haven't imagined that there's sort of like a formal panel presentation. I thought that it was a round table, and I was expected to do some...
It's round table, only it's horizontal in this case.
Short intervention. But anyhow, I have only 5 to 10 minutes, so let me dive directly into my remarks. So I work for the International Monetary Fund, and currently I am part of the Korea desk, and we have conducted the annual consultation with the government just now, and the report coming out of that consultation is pending publication. We are hoping that it's going to come out within next weeks. So one of the big topics that we touched upon and discussed with the authorities, of course, was what would be what's going to be the sort of Korea's take of the QE tapering, as well as on the one hand, the so-called unconventional monetary policy that was led by the U.S. Federal Reserve is now clearly going into a tapering phase. The matter is just the speed and timing. But at the same time, Japanese government, with the new Prime Minister Mr. Abe Shinzo's leadership, is actually expanding its unconventional monetary policy. So we basically looked at the implications of both U.S. QE and Japanese QQ, so-called QQME, quantitative and qualitative monetary easing, QQME, on what's going to be the spillover to Korea, both through the capital flow channel as well as the trade channel. But I'm not going to go through all of these things. I'm going to, given the time, just confine my remarks on what has been the development so far since the QE tapering shock in May 2021 of last year, when the then President Ben Bernanke made a remark suggested that the QE tapering might come far earlier than people thought. So since then, a lot of emerging market countries, in India, Indonesia, Turkey, Mexico, a few emerging market countries have clearly seen a huge surge in, the volatility, market volatility. And their stock market price and the exchange rates are still, in a depressed state. And on top of that, this year, starting in January, especially, when there was a market fear about potential Argentinian default, January 21st, then turbulence started again. Now, how did Korea fare these two, shocks? Especially related to the capital flows to the major emerging market destinations. Surprisingly, I looked at this number again, cumulative capital flow since the May 21st last year. What is different this time around is that Korea typically has been, coined as, the typical the jargon that Korea has been named for is a high beta country, high financial beta country, meaning that whenever there is a turbulence, like a common shock, Korea moves further. So whenever there's a rebound, Korea bounces more. Whenever there's tumble, Korea, it goes down in a more exaggerated fashion compared to the EM peers. But then somehow after May 21st last year, when Bernanke shock hit the market. There was an initial phase of capital outflow from Korea, but then the capital flow came back again in about 2-3 months since summer of last year, and then both bond and equity actually. If you look at these flows on a cumulative basis, that had both bond and on the bond front and the equity front, the capital flow actually continued to come in to Korea. That was in a sharp contrast with the other emerging market countries where they saw huge sell-off, continued sell-off in a systematic basis. So, what's the reason for that? We basically identified four reasons. The first one is that overall, the level of Korea, the resilience of the Korean financial system has really strengthened. In the run-up to the Lehman crisis in 2008-2009, the most prominent weak spot that all the credit rating agencies were talking about, Financial Times was talking about in terms of Korea's vulnerability, was large exposure of Korea's banks to short-term external debt. Now, the short-term external debt has really gone down very, very dramatically, partly reflecting, there's just a cyclical downturn that doesn't require that much funding in the first place. But also as a result of Korea's judicious use of the macroprudential measures that was basically aimed at actually curtailing external borrowing. So that was the first factor. And now the second one was, of course, in the run-up to the QE tapering in May 2013. Unlike many other emerging market countries that had seen a huge, capital inflows, Korea didn't have much capital inflow in the first place, especially on the equity front. So that's another thing. mainly because in early 2013, when emerging market capital flows were really, really strong, Korea suffered from escalated tensions, North Korea tensions of this, escalated bellicose remark by the new leader Kim Jong-un and so on. So that basically, triggered the outflow of the capital. So there was no financial excess in the equity market in the first place. And the bond side, what we found was interesting is that now bonds flows to Korea are coming from increasingly diversifying investor base. Previously, it was mainly led by foreign banks, international banks, like Lehman Brothers, but after the Lehman crisis, it's increasingly coming from sovereign wealth funds, pension funds, and the central banks. And quite a bit of these flows are coming from within the region, within the Asian region, from Thai central banks, China central banks, and so on. So we did some regression and found that actually Korea bank flows, the bond flows to Korea show some type of a safe haven behavior, meaning that when the volatility index that Dr. Manzullo just mentioned, the Chicago VIX index increases, actually bond flows to Korea increases rather than decrease. Which is a huge contrast to the bond flow to other emerging market countries. And the fourth reason is, of course, Korea's current account surplus, very large and growing, and it really has built up a significant amount of international reserves now, about 32 billion US dollars, which is 30% of GDP, as well as Korea continues to show the structural surplus in their fiscal balance. So the fundamental factors. Now I'm out of my time, so I'm
no, that's good. That's a good segue. Dr. Park?
Yeah, thank you very much. There have been a lot of controversies in recent weeks about tapering of QE by Federal Reserve. But I think the impact of that tapering on U.S. economy and U.S. financial market has been relatively muted. Stock market is not severely impacted. In fact, the aftermath of this tapering is felt far more severely in some of the emerging economies. As Dr. Lee mentioned, a country like Turkey, India, Brazil, Argentina, where they experienced sharp capital outflows and very speedy the currency depreciation, etc. But like in the U.S., this tapering had a relatively little impact on the Korean economy. And for that matter, not much on East Asian economies. In my opinion, the reason is that since the 1997-98 Asian financial crisis, the East Asian countries have immunized themselves against any future major financial shock or crisis. We see the proof of that in the aftermath of the global financial crisis, triggered by the Lehman Brothers bankruptcy and the current Eurozone financial crisis. So, for Asian economies, particularly economies like Korea, the tapering, Federal Reserve tapering, may not mean that much. For the financial market, Korean stock market has been performing reasonably well, and the Korean growth prospect has not been severely impacted by Fed tapering. But Korea does face, I think, more long-term structural economic problems. Even though they relatively fared well in the midst of financial crisis and also recent Fed tapering, you see the historical trend of economic growth rate in Korea, it shows unmistakable sign of kind of the growing old. In the average annual economic growth rate in Korea in the 70s and 80s was over 9% annual growth rate. But in the 1990, it slowed down sharply to in the 6% range, and then 2010s in the 4% range, actually 4.2%. In the last several years, below 4%. In fact, the IMF just came out with a projection of Korean economic growth rate of this year and next year, just announced yesterday, because IMF made a projection on the eve of the G20 finance minister and central governors meeting in Sydney, Australia this weekend. And according to IMF projections, Korean economic growth rate will be around below 4%, 3.7, 3.8% range. Probably Dr. Lee knows more about the inside story about that. So this structural problem in Korean economy, resulting in sharp slowdown in its economic growth rate, is more than tapering things. By the way, this tapering can be rather confusing for many countries, particularly the emerging economies, because on the one hand, there's a tapering in the U.S. by Federal Reserve, but continuing monetary easing in Japan and Eurozone countries. Eurozone and Japan is the second and fourth largest economy, and so there's a lack of coordination in the monetary policy. And I think IMF made a very valid statement yesterday that there should be closer coordination among major advanced economy, particularly U.S., Japan, and Eurozone, about both timing and the kind of adjustment of their monetary policy aspect. But I think Korean economy should be looked at not from the perspective of whether there's a monetary easing might be stopped or suspended or withdrawal, etc., but more look at the structural problems. In my opinion, the prospect of Korean economic growth rate is not very bright. Not only looking at the past historical economic growth rate slowdown, but in terms of the economic structure, Korea is still very much the manufacturing and export-focused economy, which is kind of the outdated for a country like Korea. They should focus more on the service sector, but unfortunately, the Korean service sector account for only about 40%, well below the OECD average. And the main reason for the slowdown in the growth of service sector is government regulations. Regulation after regulations. And also in what the productivity in the Korean service industry is much, much lower than that of advanced economy. For example, it is estimated that the productivity in Korea in the service industry is only 1/3 of Switzerland and 1/2 of the US. I think the reason is not because of the lack of skill of the Korean service sector workers, but the composition of Korean service sectors, because the Korean service sector is concentrated more in the low-value infrastructure services, such as wholesale, retail sales, lodging, food services, etc. And Korea is relatively underdeveloped in the knowledge, high-value knowledge service industry, such as banking and finance, medical services, engineering, telecom, IT, and software services, etc. And therefore, in order to upgrade the Korean economy, we Koreans, I think, have the ability proved by the the resounding success of major Korean multinational corporations like Samsung Electronics, Hyundai, Motors, and POSCO, Pohang Iron and Steel Corporation, etc. I think Koreans have necessary skills, but government have been foot dragging about deregulation in the service sector. And I really greatly look forward to the announcement to be made by Korean government next week about their 3-year economic plan. I think this is a resurrection of all the 5-year economic plan things practiced in the Park Chung-hee regime and that successive military government. Those economic plans have been outdated, but finally the Park Geun-hye government think that we need to really jumpstart the Korean economy, particularly in the area of the service sector. I think they're going to announce. I really eagerly look forward to their plan, which should focus, as I say, about the high-value service sector development rather than the low-value infrastructure services. Let me stop here.
Okay, good. Thank you. Dr. Cargo.
Okay, thank you. The title of this session was, didn't know quite how to interpret it, the word unpredictable markets. From an economist's perspective, markets are not predictable. But we want to really, I think, rephrase it as to stability or instability of markets and in terms of how markets absorb information, new information, and especially policy regime shifts. And two, we want to keep in mind there's short run and there's long run. And what I want to do is I want to talk a little bit about policy regime shifts and in particular central bank policy and from a longer run perspective. In my view, that we are exposing ourselves to great instability because of the role of central banking. I put together a list of 10 points since I had limited time to kind of summarize my views. The first is that, the last quarter of the last century was remarkable in terms of macroeconomic performance. Disinflation throughout the world brought inflation under control, significant economic growth, and incredible reinstitutionalization towards liberalization and shift in attitudes from pro-government to pro-market. The second point is that the transition to the new century has likewise been remarkable from a macroeconomic and institutional perspective, especially in Japan and the United States. We've had asset bubbles, a burst of asset bubbles, unstable economic growth, and most significantly, a shift in attitude, a reversal from pro-market back to pro-government policies. Third point is that the shift in attitudes towards pro-government policies, which I like to think of as the second coming of John Maynard Keynes, has been unfortunate for two reasons. The first is it's a gross misreading of history. In Japan, and especially the United States, monetary policy errors by the Bank of Japan and the Federal Reserve, combined with flawed financial regulation and flawed financial structures, generated asset bubbles. In Japan, the asset bubble was in equities and in real estate. In the United States, in real estate, primarily residential real estate. And the burst of those bubbles created tremendous economic distress in those two economies. In fact, the burst of the bubble in the United States created the international financial crisis of 2008 and 2009. And the second unfortunate aspect of this regime shift towards old-style Keynesian government activism is that the expanded role of government really hasn't had a significant effect on growth trends. But what it's done is generated very large fiscal imbalances and, most importantly, placed unrealistic expectations and responsibilities on central bank policy. And I don't think a warning that Milton Friedman gave in 1968 can't be repeated enough. In his presidential address to the American Economic Association, and you have to keep in mind, 1968 was the eve of the Great Inflation in the United States, and really inflation throughout the world, where monetary policy became very activist, very Keynesian, belief in the Phillips curve that you could buy economic growth by bringing out punch bowls. And Friedman said in 1968, we are in danger of assigning to monetary policy a larger role than it can perform, in danger of asking it to accomplish tasks which it cannot achieve, and as a result, in danger of preventing it from making the contribution that it is capable of making. And I think that we are making that same mistake and not taking this warning to heed. The August 2011 cover of The Economist magazine, I think, captured this perspective with a slight change in a famous painting by Rembrandt called The Anatomy Lesson, where one of the doctors comes in and says, "Stand back. I'm a central banker. I can take care of everything." British humor always comes. And the increased politicalization of central bank policy, irrespective of the de jure relationship with government, has generated, in my opinion, much economic and financial distress in the world, as governments refuse to deal realistically with structural problems in their economies and to deal with their fiscal imbalances. And for those who think that central banks can be rendered institutionally independent of the government, the evidence suggests otherwise. The concept of an independent central bank, in my opinion, is a myth. It is de facto dependence, not de jure. It is de facto independence, not de jure independence, that determines whether the central bank will be a stabilizing influence on the economy. And de facto independence is determined by the political economy in which the central bank conducts policy. Now, not all countries have been or are subject to the same problem in this regard. Consider Korea, Japan, and the United States. I've put together three figures to sort of illustrate this point. The first figure shows a index of the monetary base using December 2001 as 100, and you can get sort of a historical perspective of monetary policy in these three countries. The United States stands out dramatically in terms of significant increase in the monetary base, with a high variance, by the way. Japan monetary base, of course, has not increased as much, but has fluctuated, partly as a result of the pressure that the Koizumi administration placed on the Bank of Japan to become a deflation fighter in the first few years of the new century. And then as soon as the Bank of Japan and Koizumi left, the Bank of Japan went back to normal monetary policy. You can see that the monetary base declines. And then, of course, under the new management of the Bank of Japan, monetary base is expanded again. Korea is a much more stable monetary policy. The variance is lower. It has increased, but so is the Korean economy. The second figure shows the structural government balance as a percent of potential GDP in the three countries. You can understand then the political economy background in which these three central banks operate. Korea has surpluses. They don't have are facing the same pressure from their governments. Whereas in the United States and in Japan, the central bank has simply become an enabler of fiscal imbalance, despite the newfound independence of the Bank of Japan in 1997 and the highly touted independence of the Federal Reserve. And then the third figure shows real GDP growth from 2000 to 2013 in these three countries. And I'm not going to argue that there's a one-to-one correlation between the monetary policy and growth, because there are an awful lot of other factors going on. But the simple fact is Korea's simply done better than the other two countries, period. Higher growth and higher average growth over the period. And I would attribute part of that, at least an important part, to a much more stable central bank policy. And then finally, so in general, the real potential instability from a long-run perspective, both in the United States and Asia, comes from a combination of the unwillingness of governments to make the necessary structural reforms in their economies and the inability of the politicians in those countries to deal with fiscal imbalances in a way that doesn't interfere with economic growth. I mean, it's easy to just say tax the rich and that's how we'll solve the problem. That'll just make it worse. The unwillingness to do these things has, as a result, politicized central bank policy to cover up for these government policy failures. Thank you.
Dr. Patrick?
I gathered that my position was to sort of provide some general context because I essentially agree with almost everything everybody said ahead of me. They've said everything.
You're the cleanup batter.
I'm the guy who can provide some context or something, a different kind of context, I suppose. And in terms of Korea, essentially, I'm a long-term amateur follower of the Korean economy. I think that's a good description of me. And so I know something about it. And what I think we should start with saying that we shouldn't be referring to Korea as an emerging economy. It's emerged. It's now a well-developed, high-income, manufacturing, sophisticated, services weak economy. And the things that were said about Korea by Professor Park, all I wanted to do was substitute the word Japan and just say a little more mature and a little less successful or a little further along. Was sort of my reaction on that. So we're talking about, when we talk about Korea today, the fact that the growth is slower today, Professor Park worries about that as something, I think that's natural and inevitable. And for me, in an economy with its structure and size, to grow at 3.8%, I think is pretty good. He thinks it's bad, I think it's good. And the question is really, where does the potential for growth come from? And the rapid growth of Korea, I regard it as one of the most successful cases of catch-up from having the human resources and education, but not the technology, and being very successful in bringing in foreign technology, developing its own technology, growing very rapidly, as Professor Park pointed out. But eventually you catch up. You absorb almost all of that technology. So in the future, the question is really, what sort of rates of innovation worldwide or within Korea will occur that will enable the economy to grow. And Japan, in a sense, is in a similar position. The other thing that's going to make what we're going to define as good growth being slower, say 2%, something of that sort, is the fact that eventually the labor force in Korea is going to decline. And when we think about growth, we think about improvements in technology and we think about increases in the labor force. And Japan is already in a situation in which the labor force is decreasing, and Korea will be in that situation soon. So, in a sense, I think well, my personality is optimistic, and perhaps Professor Park is a more skeptical person. I don't know, but I think that to see Korea growing in the next decade at 3% plus 3.5% will really be a quite good performance, and And as he points out, and I would agree that I think the same problem is true, particularly for Japan, is how do you shift first into higher technology manufacturing and get away from labor-intensive manufacturing? Or more importantly, how do you get productivity in the services up? And that's the big challenge for Japan and for Korea. China is still at very early stages of simply absorbing labor into manufacturing. And on what's really interesting is about the discussion of tapering off and who gets hit by it. And I think Korea perhaps learned better than any other country about the dangers of relying on short-term foreign capital inflows in order to finance domestic business investment. And that was the crisis of 1997-98, and they learned a lot from that. Still, they borrowed a lot in 2005, 2006, and they got hit again, but not as badly. And now they've hardly been hit at all because they have made the changes, and the rest of the world has realized this isn't an emerging dangerous country. This is a pretty safe country. And so the capital hasn't flown out the way it did before. And I think these are significant indicators of change in Korea that are different from, say, Indonesia still hasn't learned the story, the lessons, and India has lots of things to learn. And for me, how large your current account deficit is a major indicator of whether you're going to have trouble when the tapering off goes. And Korea, for reasons I don't fully understand, is one of the few developed countries, I call it a developed country now, that has strong domestic private sector demand. So it doesn't need to stimulate the economy by either zero interest rates or the sort of fiscal policy that the United States and Japan have pursued over the last 10 or 15 years to achieve full employment growth. That was sort of my thoughts as I was responding to the comments. Like Tom, I didn't know what unpredictable markets meant. He says they're unpredictable, and I say that within a broad range they're rather predictable. So if we want to predict what the exchange rate is going to be like tomorrow, probably we can we can do a pretty good estimate that it's the same as today within 95% confidence intervals. 1 year from now, a wider confidence interval. 10 years from now, who knows? But after all, we operate in it's not a random, these are not random markets. We do have some general information. The problem is the information we have is not good enough to give us a very specific prediction that's correct, absolutely correct for tomorrow or next week or wherever. And in a very specific sense, you can't predict it precisely. But we live with the expectations that we can predict more or less. But the world. So we're trying to figure out what are the things that determine that range of trying to increase the predictability, and what are the things that shock it. Sometimes you have shocks like big snowstorms, temporary shock, or an earthquake, usually sometimes more fundamental. But aside from natural disasters, we have the shocks of misguided policies, which I think is Tom's big point. And I agree very much with Tom that because the governments in the United States and Japan and Europe have been unwilling to deal with the fundamental structural issues that they have, it puts too much pressure on or creates too much of a role for monetary policy, more than we can really expect monetary policy to deliver. And so the one fundamental problem is how to have a policy system that will generate the right macroeconomic policy. He and I would agree on that. How he would do it and how I do it rather different. He's I think we've been talking, having lunch and chatting. He described himself as a 19th century liberal. And I think that's a good phrase. Many people would say that's a 21st century conservative, right? But I think the labels are the wrong thing. And he's very critical he's critical of the Fed, and he's critical of the government doing too much and doing it badly. And I'm much more of one of those damn people that are called Keynesians. So, because I really worry about where the demand is going to come from in the economy. And for me, if we're going to look back 50 years from now, the historians are going to look at this world and say, well, you know, this period has been one of great, wonderful development of the developing countries, emerging. We're really having emergence, and that's a wonderful improvement in the human condition for many people. So that's one thing that's been going very well. A second thing, how the historians will interpret this, I don't know. We've become much more of a global economy through trade and foreign direct investment, and particularly capital flows. And so our world is very different from 75 years ago or 100 years ago. So there are these positive changes, and on the other hand, we haven't learned how to handle. We haven't learned how to handle our own desires to be optimistic and greedy, and so we create bubbles. And bubbles, the trouble with bubbles is that they burst. And so then we have to suffer and go through that. And in some sense, we've done better than. To say that we did better than the 1930s is a pretty terrible statement, you know. And so historians are going to come back and look and say, well, how do they deal with the problem of? For me, the big problem for the developed world is the lack of domestic demand. And the traditional Keynesian solution was to have the government deficit spend. And I think we found we can't rely on that in a sustained way. It's supposed to be a temporary cyclical thing. We can't do it as a structural. It becomes a structural problem, not a structural solution. Monetary policy, we thought, oh, well, it will help because it'll change the price, and that's the prices that we're talking about, the price of the cost of money and of capital and so forth. But for reasons I also don't fully understand, we're down to this zero interest rate world because we've not been able to solve the problem of aggregate demand and full employment, and this is the way we've tried to go. Where Tom and I would probably differ, and don't push us on this because we get too much of a technical debate, is he would say, let the markets work, get the government out of it, government screws things up. And not that he would say markets are perfect, he certainly wouldn't say that, but he would say they're less bad. I would say I trust markets very much, but I don't want them to be the guarantor of social well-being. So I'm more willing to see the government play an interventionist role. Maybe let me stop here. I'm saying too much already.
Yes. Before we open up for other questions, Dr. Park, did you ever rejoin her? Okay.
Yes,
and Dr. Cargill and Dr. Reed, if y'all want to jump on Dr. Patrick, that's fine.
Sure.
Yeah.
That's why I'm near the exit.
I see why Professor Hugh Patrick is an expert in Asia, has a relatively rosy and optimistic view of the East Asian economic performance. I think if you look at statistics, certainly it's very impressive. There's no dispute about that. What I'm saying is that if you look at the trend, that is what is worrisome. You know, not only there is a market slowdown in the economic growth momentum in the last 10, 15 years, but also structural changes is pretty disappointing. For example, the Korean industrial strength lies in huge multinational corporations like Samsung and Hyundai, etc. But these large Korean firms have located their manufacturing facilities abroad during the last 15 years, according to statistics, about 20%. And also, their share of the workers employed by these large firms went down by 1/3 inside Korea. What does it tell you? The real strengths of Korea tend to be siphoned up abroad, and there must be something terribly wrong. And what something terribly wrong is that excessive regulations, aging populations.
You think
etc.
aging wrong population is wrong? No, come on.
No. What I'm saying is,
I have a vested interest in.
yeah, you are the exception. Okay, that's why there should be some structural transformation to recapture the dynamism of the Korean economy as in the past. That's what I'm saying. Okay.
Sure.
Also, I tend to agree with you. Actually, Professor Cargill seems to be overly critical about the role of central banks in the last two crises, the subprime mortgage crisis, 2008, 2009, and the Eurozone crisis. But I like to propose that without such an activist, unusual central bank intervention, I think this U.S. global financial crisis could easily exploded into much bigger than. It was already a pretty big crisis, and impact was severe. But without central bank intervention, it could be much. Same is true in Eurozone, etc. And I'm glad that Japan, its government, decided to replace the Bank of Japan governor for more activity. I think so. Yes, probably on the theoretical level, certainly you may argue with some of the details about central bank actions among these three major economies. But overall, I think they did pretty damn good jobs.
Dr. Cargill.
I use a polite term, by the way.
Well, I couldn't disagree in more stronger terms. I think we've done a very poor job. It is true that the actions of the Federal Reserve and banks around in 2008 were justified. That's what a central bank is supposed to do in a liquidity crisis, is simply put as much liquidity into the system any way you can do it to keep the inverted pyramid from imploding on itself. And the Federal Reserve did that. And it's easy to be a Monday morning quarterback and say, well, you shouldn't have done this, you shouldn't have bailed out AIG, and so forth. But I suspect that most economists have a positive assessment of what the Fed did. But you have to look at this in a broader historical context. The Fed was a major cause of the problem to begin with because of unprecedented easy monetary policy combined with an incredibly flawed financial structure supported by government-sponsored enterprises like Freddie Mac and Fannie Mae, created the asset bubble and then lax regulatory oversight. The evidence is just overwhelming. Same thing happened in Japan. The Bank of Japan engaged in a very expansionary monetary policy with a flawed financial regulation and structure of its economy, and that generated an asset bubble. It's a much more complex process in Japan than it was in the United States, but it created an asset bubble in equities and real estate. And the reaction of the Federal Reserve to the crisis, partly of which it created, was appropriate. But then it continued with quantitative easing. Let's see, we've had QEP1, QEP2, QEP3. We've had Operation Twist. We've had to taper or not to taper, as Shakespeare said. And then now we're tapering, but if you really believe that the Yellen Federal Reserve is going to continue tapering and allow interest rates to go up, I've got some stock in the Brooklyn Bridge I'd like to sell somebody afterwards. I just don't think it's going to happen. Once interest rates, the real test will be when interest rates start to increase. And I think you're going to see a Federal Reserve pull back. But anyway, with full respect to Dr. Park, I couldn't disagree more strongly.
Dr. Ray,
Yes.
look at the trouble you caused down there, Dr.
That's why we want him, right?
Rather than responding to very insightful remarks by three professors, very prominent professors, let me just add some comments and observations. First, on the remarks by Dr. Cargill on the relatively stable implementation of monetary policy in Korea. And then I would like to also have some quick remark on the growth, where is going to the growth come from, and what's the service sector reform has to do with it. So on the monetary policy, definitely if we look at the huge expansion of the Fed balance sheet and the Bank of Japan balance sheet on the QE, and there's certainly an aspect of that politicization of the central bank activities, and just it being mobilized to fill in the policy failures of in the part of the government. But I'm not sure that the fact that Korea's monetary stock or the balance sheet size of the balance sheet of the Bank of Korea has been relatively stable. The stability is coming from the fact that Korea has no reason to fundamentally deviate from the traditional conventional monetary policy, right? So it's still inflation targeter. And it focuses mainly on interest rate channel of the monetary policy, rather than trying to use the quantitative aspect of the balance sheet of operation to affect the economy, because the Korea is far from zero interest limit, so it still has a monetary policy room. But if you look at the experience of since the 2007 and 2009 global financial crisis. Korea has cut down interest rate quite significantly. So they were they were not shy on sort of proactive counter-cyclical response to the business cycle development. But then after that, the criticism was that the Bank of Korea has not been as active a lot of observers have pointed out asymmetry in the way they accommodate. They basically pull the lever for accommodating monetary policy, and when the cycle turns, when they have to put the switch back, there were an element of asymmetry in that, and a lot of people have argued that might have been an issue of a potential financial bubble or instability within Korea. So I would like to get some further clarification on that aspect from Dr. Cargill.
Okay, can I?
Sure,
By the way, there is some the incomplete explanation of the true causes of global financial crisis. Many think that, particularly economists tend to think that main cause is a real estate bubble fed by excessive the central bank easing of their monetary policy. But that is only part of the story, because yes, in the last 80 years since the great crash of late 1920s, during the 80 years, there's a lot of the bubble burst. but it did not lead to the spectacular global financial crisis, because in order to complete the story about the true causes of global financial crisis and the subprime mortgage crisis, not just the excessive Federal Reserve, the monetary easing and excessive low interest policy in the aftermath of dot-com bubble burst, because bubble always tend to goes up and then burst, and etc. But this time it was different, because it was combined not only with the real estate bubble burst, but also explosion in the very sophisticated financial market product like CDOs, collateralized debt obligation, which is far more sophisticated than traditional securitization product like mortgage-backed securities and collateralized mortgage obligation. Because CDOs really gave kind of free check to Wall Street to print money for themselves. It's too complicated to hear, but along with that, also there is CDS, sophisticated product which can be used to insure against risk, in the form of credit default swap. And then there is something called the overnight repo market. And what is the immediate cause of the collapse of Lehman Brothers? Is not excessive Federal Reserve monetary policy, etc. Because the Lehman Brothers has a total asset of $600 billion. But they have to finance half of the balance sheet, $300 billion, every day through the overnight repo market. Every day. In order to finance, you have to borrow $300 billion every day. They use this overnight repo market, but the repo market rely upon so-called third-party clearing bank, and J.P. Morgan played a major role, and they refused to extend the credit, and therefore they could not finance that huge things. Why AIG was a near collapse? I'm almost about to collapse, because they wrote so much CDS contracts, credit default swap contracts, which is very similar to insurance. But no, it was not insurance. It's a Las Vegas gamble done in the plush offices in Wall Street. So if you look at the nitty-gritty of the global financial crisis, you cannot just say that, oh, it is a central bank fault. You guys kept interest rate too low, too long. And combine that, global imbalances. These East Asian countries, they have excessive foreign exchange reserve, and so they invested back in the U.S., and everything exploded. But it's not. So I think in this kind of complicated situation, Federal Reserve did the right things to inject the liquidity. Because otherwise it will be not just the Lehman Brothers, and Merrill Lynch, which was near went, but it could be, Morgan Stanley, Goldman Sachs, and then Citibank, and everything along with that. So I'll not be that harsh toward the central banks.
Let me respond to Jack's comment about BOJ policy, BOK. There are two things that they have not had to deal with that the United States and the BOJ has. Korea does not have negative fiscal imbalances. If anything, we've got surpluses. So that takes a lot of pressure away from the central bank. Both Japan and the United States are using their central banks to accommodate deficit spending. That takes less pressure off of the politicians to make the structural reforms, try to solve problems just by spending money. And so as a result of that, Korea's economy, and then on top, Korea is an incredible success story in terms of the financial or the changes in the structure of their economy that they have made as a result of the financial crisis in 1997. The Korean economy really collapsed suddenly, and they learned their lessons far, far more than the Japanese did. In fact, you and I wrote a paper sometime, maybe 10 years ago, comparing Japan and the United States and Korea as to why they had a different response. And Korea is a real success story, and it does show up. And I don't get concerned because GDP growth has fallen from 7% down to 3%. I think 3% is very, very healthy, especially at non-inflationary growth. Very healthy. And Korea, of course, does have some long-run issues. More reform is needed, and it's got some population problems. Now, back to this point about central banks. I don't think Dr. Park listened carefully.
No, he did.
I did not say that it was a mistake to intervene when Lehman Brothers collapsed. However, the monetary policy in both the United States and Japan and Europe has been a source of instability. And not by itself. It's combined with flawed financial policy and financial structure. In the United States, the problem was an intense social contract to support home ownership and government underwriting and of low-quality mortgages, either explicitly or implicitly through lax regulatory oversight. Now, you mentioned AIG and the credit swap guarantees and that sort of thing. And I put a lot of blame here on the regulatory authorities. I don't put so much blame on AIG. They're just trying to make a buck, and if they can get away with something and get a very highly leveraged product, they're going to make a lot more money. But here we've handed all this power to central banks, and the regulatory authorities are supposed to save us from this. They knew that these were inherently bad contracts because they had no reserves. There was no reserves between these credit.
Let's open up to some questions on the floor. We have a mic over here, and Mark, you want to go over there? When I sat on the House Financial Services Committee, Dr. Ron Paul was to my right, not philosophically, but in terms of seniority. So this sounds a very interesting discussion going on. And then up here afterwards. Go ahead. You want to stand up, identify yourself, and speak directly into the mic.
Yes, my name is Dan Kim. I'm a senior economist at KEDA. Thank you for your presentations. My first question is to Dr. Park. You spoke of the need to reform the regulation of services market in Korea. Could you give us an idea of where you think the ideal model would be around the world, whether it be the city of London or New York? What would be an effective model for Korea to follow as far as the regulatory regimes would be? Second question is, in the spirit of the topic that we're discussing today about unpredictable markets, I appreciate the discussion about the overall financial markets. Can you just touch upon two markets in Korea that I think will provide some volatility? One, a more domestic one, which is real estate. Seems to be a lot of instability there. And the second one is a more international one with energy, and how those markets, those unpredictable markets, might affect the Korean economy at large. Thank you.
Yeah, I think a role model for Korean service sector development, I point to Singapore. Singapore became independent in 1965, and around the same time when Korean government was serious about five-year economic plan, etc., etc. So at the starting point, both Singapore and Korea was around the same level per capita income, etc. Right now, Singapore per capita is close to 60,000. We are low 20,000, 23,000. Why? The major difference is Singapore focus on not only manufacturing at the early stage, but also they emphasize service sector, starting with the finance. Because in 1960, if you read this autobiography by Lee Kuan Yew, the founding father of Singapore, from third world to first in one generation, he mentioned that in 1968, just 3 years after Singapore became independent, when Singapore has no high-rise office building and no financial system to talk about, etc., they decide to open up Singapore as an Asian dollar market center by removing a lot of regulations and taxes such as withholding tax, etc. And then you might say, oh yeah, finance, international finance, that's different. No, that's only part of the story, because if you look at the international financials like Dubai and the Bahrain, etc., in order to develop the financial center, also you have to develop other service centers, medical services, tourism, the IT services, and education, other things. So I think this is all part of the entire package. When I talk this about to Korean friends, we are different from Singapore. Singapore is a small city state, etc. And some say that we are not as well developed as Singapore. We are not ready for international financial center, etc. But I think it's an excuse, and some effort had been made, in fact, to develop viable international financial center and to develop Northeast Asian hub in the the transportation and other service sector. During this Nomian administration about 10 years ago, but nothing came about during the last 10 or a dozen years. Korean, I think, government effort failed not because the idea was bad, but because of this resistance by Korean bureaucracies. Because regulation is their power base. So they'll use all kinds of excuses despite the pressure from the Blue House. The Korean bureaucracy resisted that. So that's why I'm looking forward to read the details of this new 3-year plan that Park Geun-hye administration is going to announce the 25th, so next Tuesday or something. Because according to press report, the main focus will be service sector development, through the drastic deregulation. I'm a bit skeptical because the last 15 years there is nothing, so much talk but not much action. But whether the Park Geun-hye administration can do that, let's wait and see.
KEI published about a year and a half ago an excellent article by Dr. Park on Korea developing a stronger financial service center hub. And that's in, what is the publication that's in, on Korea?
I think academic paper series. Yeah, KEI academic paper series.
Right, but you can access that online. Next question was over here.
Good morning, Sanjin Choi, Lennon Partners. I'm an aerospace economist. Could I comment the issues we got tapering of its impact in the emerging market? And emerging market account for 50% of global economy. And both of you, Dr. Wei, Dr. Park, you mentioned about country with external health debt as well as domestic problem caused impacting the tapering of countries like India and Indonesia. So I'll be interested in your views on emerging market. And B, Dr. you mentioned about a G20 summit in Sydney. Under the given circumstances, US is QE2, and EU's OMT, and Japanese QKME, where is room for coordination? I'll be interested in your views. Thank you.
Shall I make it first? This weekend, Saturday and Sunday, there will be a meeting of G20 finance ministers and central bank governors. Not G20 summit, but it's next level. And I think one of the major topics, and certainly one that pushed by IMF, is you guys, G20, try to develop a coordinated policy on the tapering of QE, etc., because it's pretty confusing messages. On the one hand, the U.S. is tapering side, but Japan and the ECB in the Eurozone, they are still, going ahead full force about the monetary easing, etc., and that caused the confusing signals to the world economy, but also many other G20 emerging market members, like South Africa, the Brazil, etc., they got confused, and the market is confused. The result is, the major the steep depreciation of some of these emerging market currencies and the central bank reaction of jacking up the interest rate, etc. So I think the IMF is correct in advising these G20 finance ministers that you guys have to develop some coordinated policy regarding this very important area. But probably you may have insight on this, Dr. Lee. Yeah.
Okay, I'm just Korea desk economist, and probably you should ask Christian Lagarde or someone higher up on this question. But I'm just going to repeat IMF's official lines. We looked into this issue. In the last year, there was a spillover, two spillover reports, and as well as both paper on unconventional monetary policy. So basically, the big line that they came out of several research papers that the IMF as an institution has done is tapering can be there can be both good and bad tapering. So good tapering is going to be a gradual, well communicated, and orderly tapering, which is basically driven mainly by growth. So as the Federal Reserve has made very clear, if it's led by recovery of the U.S. economy as well as recovery of the job market indicators. The monetary aspect of it, the withdrawal of the monetary impulse is going to negatively affect the capital flows for most of the emerging market countries. Probably not so much for Korea, because I did my own. Our team has done our own Korea-specific research, and we found that U.S. QE did not have much of an impact on capital flows to Korea. So it's tapering. By way of symmetry, it's not going to have much impact on, it's not going to trigger huge outflows either for Korea. But for most of the emerging market countries, we find that QE expansion actually had a huge impact on capital flows. So QE tapering will have a negative impact as well. But then QE tapering, if it's, it's not going to come by itself. It's come as a sort of like a package of things, right? Especially the more brighter outlook for U.S. growth and as well as Japan. That's going to have a positive impact through the trade channel, through the demand external demand channel. That's going to favor the emerging markets. So on balance, our IMF's view is that the overall spillover, net benefit of the spillover, there is a cost and benefits of the QE tapering, but net benefit would be positive if it's an orderly, well communicated, good tapering. But because of bad tapering, it's going to be very harmful to the emerging market countries.
Next question, Ambassador Kelly.
My question is a non-expert's one about currencies, and obviously the stable currency current account in Korea has kept a reasonably stable won value. But my question has to do with your largest trading partner, Korea's largest trading partner, China, and to what extent that the U.S. has reserve currency, and to what extent China and Korea are settling at least some transactions using yuan and the Chinese currency, and what you would just see in general terms as an outlook for that, given weakness in the Euro zone and at least political issues with Japan and the yen.
Yeah, I think there's a very important topic, questions for Korea, because China replaced U.S. as the biggest export market and trading partner. In fact, China is more than twice as important than in the U.S. market. But Korea-China trade may have very, in my opinion, negative effect on the internationalization of yuan, because that is China's ultimate goal. But yes, now is the China allowed the yuan deposit in Hong Kong and so other countries, very experimental basis, and also they try to push up the yen's international role. But as you know, out of the more than $3 trillion plus the foreign exchange reserve, about at least 50 or 60% of reserves are kept in dollars. And if you look at the foreign exchange trading volume globally, about $5 trillion per day, about over 80%, I think 85% of foreign exchange trading of the $5 trillion plus trading involve dollar as a counterpart. Chinese yuan is very second most important currency in foreign exchange trading currency is euro, and then third is yen, and therefore I think eventually China is the second largest economy, 2/3 of the U.S. economy size, and almost twice of the Japanese economy. Eventually, I think yuan may become very important international currency, but can it replace dollar as a world reserve currency? Not in my lifetime. And I am very young, so I have a very
I just want to add on that. I think that we're going to see Chinese want to see the currency used more internationally, and the natural way to proceed is on trade, because you can do it directly, and you have as a reference world prices for most of these things, and it saves transactions cost just on currency. But going beyond that to holding substantial amounts of RMB by foreigners, because I think it's a good currency to hold, that will take time, and it's very difficult. And I think the key is will countries hold it as a reserve currency? No. And I think the answer is no. Not for the lifetime of most of the people in this room, even though Professor Park is very young. I think it's going to be a very long path, and it requires fundamental changes in Chinese policy, and particularly on capital controls and on controls and on the nature of the government. Do people want to hold their foreign exchange reserves in a country that can just unilaterally make a change easily? And my guess is that the market test will be no.
My question certainly agrees with those points, but to what extent Korea businesses are seeing outliers or outriders of at least settling some transactions in renminbi. Are there some signs of this, or is that really as on slow a track as the...
No. The trade is going fast. I think, a significant proportion of trade is going directly in. That's my understanding. Between China and Japan and Korea.
Sure. So the trade as the share of China in Korea as a trading partner is very large, but I think that the question relates to which extent the trade is settled in either Korean won or Chinese yuan.
So what's the answer?
So my understanding is that it's close to zero. As of now, most of the settlement is done in international currencies, mainly US dollars. And Japan trade with Japan is settled. A significant portion of that is settled in, of course, Japanese yen. Trade with the euro area, significantly euro. But most of the Korea's trade is settled in US dollars. Now, the reason is, as other professors has mentioned, neither the Chinese, it's no surprise the Chinese yuan is not a convertible currency yet. So the surprising aspect is that Korea, as you know, with all these talks about Korea has already emerged and developed and sophisticated and so on, Korean won itself is not a convertible currency.
That's right.
So you cannot, get your. So if you leave Korea, when you're leaving, just try to, exchange all your left out ones in the airport because you're not going to convert it in Washington D.C. So that's one of the reforms that government wanted to push. Before the onset of the 2007-8 crisis, but after that, these things became sort of in the back burner, and I think it might be a good time to sort of reopen the discussion on internationalization of yuan, and. But there's certainly the policymakers are aware of the issue, and they would like to, on both China side and Korea side, want to, make it less dependent on U.S. dollars. And one of the main purpose of the Korea, there's a swap arrangement between the People's Bank of China and Bank of Korea. As probably Dr. Lee from the Bank of Korea might know very well. Many of the swap arrangement, for example, Korea-Japan swap arrangement that they had earlier, part of that, at least half of that was a swap arrangement in terms of US dollars. So basically Bank of Japan, when Korea is in trouble, basically lends out some dollars that they hold on to, kind of arrangement. But China, Korea is purely on local currency basis. So if China is in trouble, Korea lends Korean won. Korea is in trouble, they are going to lend Chinese yuan. One of the key purpose of that is to facilitate, settlement of the bilateral trade in the local currency terms.
We are running out of time. Let me just end on a note here. Madam Wu Li, who is the equivalent of the Secretary of Treasury back in China, and spoke at a U.S.-China Business Council April 22nd of 2004 here in D.C., and her remarks were so interesting I had to put them in my BlackBerry. She said, China has a, quote, market-based, managed, unitary floating exchange rate. End of quote. Figure that one out. Well, I almost feel like saying, join us next Sunday morning for another roundtable with our advisors here, but we have been really blessed this afternoon by your wisdom, your candor, and let's give them all a round of applause. Thank you for coming. Thank you so much.